This episode of the Altco's Mainstream podcast is brought to you by Ultimus, a leading full-service fund administrator for asset managers in private and public markets. As private markets continue to move into the mainstream, the industry requires infrastructure solutions that help funds and investors keep pace. Ultimus is a leading full-service fund administrator for asset managers in both private and public markets, offering a wide range of capabilities across registered funds, private funds, and public plans, as well as outsourced middle office services. Delivering operational excellence, Ultimus helps firms manage the ever-changing regulatory environment while meeting the needs of their institutional and retail investors. Ultimus provides comprehensive operational support and fund governance services to help managers successfully launch retail alternative products. Trusted by institutions, investment consultants, registered investment advisors, state governments, and fund managers, Ultimus provides solutions for nearly every investment structure in the marketplace. Visit www.ultimusfundsolutions.com to learn more about Ultimus's technology-enhanced services and solutions, or contact Ultimus Executive Vice President of Business Development, Gary Harris, on email at gharris@ultimusfundsolutions.com. We thank Ultimus for their support of Alts going mainstream.
Everybody gets a piece, we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're
creators
going mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Altco's Mainstream podcast. Today's episode dives into a groundbreaking partnership that could change the trajectory of how the wealth channel invests in private markets. We are joined by BlackRock's Head of the Americas Client Business, Joe DeVico, and Head of Alternatives for U.S. Wealth at BlackRock, John Diorio, and Partners Group Partner, Co-Head of Private Wealth, Head of the New York office, Member of the Global Executive Board, Rob Collins, as they discuss their partnership on a private markets model portfolio purpose-built for the wealth channel. Joe, John, and Rob discuss this model portfolio partnership that brings together BlackRock's private markets and technology capabilities and Partners Group history as a pioneer in the evergreen space. It's a big moment for private markets. This partnership enables the wealth channel to seamlessly access private market solutions, understand how it fits into a broader asset allocation model, and handles it in turnkey fashion. We had a fascinating discussion about this partnership and why the wealth channel needs turnkey solutions such as model portfolios. We discussed why model portfolios could be the iPhone moment for private markets, as Rob said, the anatomy of partnership between BlackRock and Partners Group to create private markets model portfolios, how to balance personalization and customization with standardization of delivery to the wealth channel, how to create differentiation with private markets offerings with different types of product structures, the mechanics of a private markets model portfolio, and how education plays a role in advisor adoption of private markets products and model portfolios. Thanks, Joe, John, and Rob, for sharing your wisdom and experience on public and private markets as you help bring private markets into the mainstream.
We're going mainstream.
Welcome to the Altco's Mainstream podcast, live from the BlackRock studio. So, pleasure to have you all here. I think we have a really fascinating conversation on tap, really the merging of public and private in a sense. We have Joe and John from BlackRock. We have Rob from Partners Group. Both firms have done incredibly well in their respective businesses and now coming together to create this really interesting partnership around a model portfolio in the private market space. So would love to start with your backgrounds. I think that'll inform a lot of parts of the conversation in terms of how you're both thinking about this. So Joe and John from the BlackRock side, would love to start with you as we unpack your backgrounds, and then Rob will get to you in terms of the partnership between BlackRock and Partners Group. So Joe, take it away.
Well, thank you, Michael, and thank you for having us today on your podcast. So I've been in the business for almost 30 years. Started my career at a firm called Kemper Funds back in the late 90s, and I've been with BlackRock for the last 25 years. And as I look at the wealth market, I've always been really just amazement how the wealth space has been underinvested in alternatives, especially vis-a-vis the institutional market. And I just think this is like the moment in time where the opportunity is just going to be very, very interesting for the wealth space. And that's why we're so excited about this opportunity with Partners Group and building a solution that we think will be very, very commercial and very successful for our wealth clients.
That's a great segue to you, John, because you've been on the product construction side, and it sounds like that's a large piece of putting this all together and fitting the pieces of the puzzle between public and private together.
Absolutely. I'll echo Joe's sentiment. Thanks so much for having us, John Diorio. It's very exciting to be here with you. So I've been in the industry for about 20 years, the entire time on the wealth side, about a decade at Deutsche Bank and about 13 years at BlackRock, and have had a variety of product and client roles, and really echo what Joe's talking about, which is we see a real inflection point. And so last several years, I've been working a lot on our private markets alternatives business. So I currently head our alternatives business for US Wealth, but also spent a lot of time in my past life on models and thinking about how all these things come together. At BlackRock, we have a models business that goes back all the way 10 years. So we really think bringing these things together, especially with a great partner like Partners Group, is really going to be exciting.
Great. And Rob, returning guest to Alco's Mainstream, you talked a lot about evergreens and the history that Partners Group has there. Would love to hear your background and then the perspective of why you two decided to partner together on this.
Well, it's great to be back. Thanks, Michael. So my background, I've been at Partners Group for 20 years now. And before that, worked in private equity and in investment banking capacity for about 5 years. And 18 years ago, started the evergreen wealth journey. And we were asked by a client, why hasn't the industry done anything about this allocation adoption gap? And I and my colleagues at Partners Group really leaned into that in classic Partners Group fashion. We love solving problems. We love hearing from clients who need solutions. And that's the journey we've been on, is really establishing evergreen as a proven capability where you can have the best of both worlds in terms of an investment outcome and then the simplicity and elegance of the solution. And we feel like with this incredible partnership that we recently announced, that we are at this iPhone moment, and that we are changing the paradigm for the industry, capturing a number of these really important themes, not only the adoption of private markets, enabling that adoption, but some other important things like simplicity and the personalization that comes with these solutions we're developing.
I want to double click on that real quick. What do you mean by the iPhone moment?
I've been thinking about this recently. If you look at the journey the last 18, 20 years ago, we started this journey, which was how can we address those needs of the financial advisor and the end individual investor. And this is much of what we had talked about in our prior episode. How can you solve for those age-old impediments around performance reporting, tax reporting, getting invested, right? The J-curve, cost, all of those things. And we've done that. The industry has now done that in a big way in building a number of individual evergreen fund solutions. And that's terrific. And that has helped on this journey. But as Joe mentioned, there's still a gap. Mm-hmm. If you look at the large wealth platforms, if you look at the number of financial advisors and the individual investors that still have yet to adopt and to diversify their portfolios. And again, just real sidebar, why is this an important topic? Because the economy, as I think your listeners know by now, has been shifting public to private. So they need to have this diversified portfolio. So it's been outstanding to see these products, but now you've had, some would say, a paradox of choice. Some would say analysis paralysis. I've called it the Sherwin-Williams challenge, which is, okay, I have all of these solutions now. I have all of these individual products, but how do I really build that thoughtful portfolio simply, efficiently? And that's why this is an iPhone moment, because we're going to have the simple, meaning single click, push button, immediate access to a diversified portfolio across many different dimensions. Simple, easy to use for existing private markets investors, new users, and solving this challenge now of too much choice. So that's really what we're doing. And we think it's iPhone moment in that it will fundamentally change the landscape and enable this adoption of private markets.
And Rob's point's really interesting around the model itself, because we've seen this incredible uptick in public market models where, 10 years ago, we probably saw $0 in that space. Today, it's probably $5 trillion. And we estimate that number is going to double in the next 5 years to $10 trillion. And now with the inclusion of private markets, it just kind of fits into how financial advisors are thinking about their own business, how they're thinking about scaling their business. So they spend more time with clients and prospects and less time trying to figure out how to actually manage a portfolio, especially a portfolio now with private markets.
That's a really important point, and marrying that with what Rob said around make it easy, creating a solution that is comprehensive rather than kind of single point solutions and making people choose. Obviously, BlackRock has been at the forefront of that in the traditional world, model management. You have Aladdin, desktop real estate for advisors. I want to unpack the concept of creating a solution. What was it in your conversations as the world's largest asset manager with advisors that made you say, John, I'll start with you, we need to create a comprehensive solution here?
Yeah, I'll dovetail off of what Rob said, which is I think the industry is making a lot of progress in private markets, especially with these evergreen products. But it reminds us a little bit about where mutual funds or other types of assets classes were over a decade ago, where sometimes when there's a lot of choice, the client or the advisor needs some help putting together the portfolio. And we always said a portfolio of your best ideas is not necessarily your best portfolio, right? Real estate may be hot, and then credit may be hot. And how do those things all interact with each other? And so point one is what we think this solution can do is think holistically around private markets and how all these things interact with each other. And to your point, doing the risk analytics that BlackRock and Partners Group brings to this, to think about those things, so you're not just building a portfolio of your best ideas, you're actually building a portfolio that makes sense from a client standpoint, and specifically helping clients and financial advisors manage some of the things that I think are tough. Why are private markets able to outperform? Well, you have to deal with illiquidity and things like that. So how does a typical advisor think through that? They may want to outsource that to a BlackRock and Partners Group. So I think that's really important to element number one. The second element is what Joe was hitting on, which is that practice management element, which is private markets can be hard. You don't want to combine multiple subdocs. You want to have aggregated tax reporting, how you think about going from K1 to 1099s. How do you think about rebalancing? So I think those are really the two main elements to the solution, which is how do you think about the investment piece of it, and then how do you actually think about activating it and making it easy.
And we heard a lot of clients simply just tell us, I don't know how to get started. Like, where do I actually start? Which asset class should I start with? What type of product should I start with? So there was just a lot of demand for private markets, but the need for something that made it much easier to get started. And then if you just look at the numbers for a moment, Michael, if you look at the U.S. wealth industry, it's $50 trillion, of which about $2.5 trillion in private markets. You can see it's just like very underinvested in what we think is a really interesting spot. And we thought that divide was the access and the easiness and the convenience of the platform for the financial advisor. And again, that's why we thought this was such an exciting opportunity.
Why is now the right time for this? And if I unpack my own question a little bit there, what I mean by that is there's been a lot of talk about liquidity versus illiquidity, how you think about risk in private markets versus public markets. Why, Joe, do you feel, you spend a lot of time with clients, obviously, now is the right time to do something like this?
Well, I think maybe 5 years ago was the right time to do something like this, but the technology has caught up. Number one, with UMA platforms and SMA platforms. Number two is the actual solutions. The evergreen funds have caught up, and thanks to Partners Group and everything they've done for a long, long time, many other asset managers now have a more efficient wrapper, a better wrapper, the 1099 instead of the K1 and the drawdown, just much more appealing to our clients. And to John's point, the adoption of models in general, and that whole practice management has become such a powerful force, such a powerful way of doing business. And all those things coupled together, that's why the time right now is really, really perfect. But quite frankly, if we could have done it 5 years ago, we would have done it 5 years ago. But the market wasn't quite ready. The technology wasn't quite ready. The wrapper wasn't quite ready. But now it's ready to do something really special.
I want your perspective on that, Rob, because I think you've obviously had to educate the market on evergreens, and you've seen how advisors interact with evergreens from the private side, right? And you're thinking about how to solve for their private portfolio. How have they interacted based on what Joe was kind of sharing around market being ready, advisors wanting this, advisors knowing how to actually interact with private markets and ways of doing it like evergreens?
I think the space has matured quite a bit, so the timing is good. And I'd echo everything John and Joe have said in terms of some of these underlying themes about simplicity. And, I've used this expression, life is too short, right? So everyone is trying to find simple solutions. And I think the broader adoption of these evergreen funds is part of the story in terms of why now. I also think there's a bit of serendipity here in that, back to your earlier question, we have common clients, and that's where solutions come from. And we have some large common clients who have said for a few years now, what about this? How can you replicate that model experience? How can you replicate that UMA type of experience? And a little serendipity, our firms, happen to be having a number of conversations. We're clients of each other. And we said, look, this is a big challenge. And I think both firms love to listen to clients and solve problems. So the timing was really good from that really sort of simple point of view in terms of having this ongoing dialogue at a point in time when the industry was ready. The advisors are ready. And part of that industry maturation is, okay, these funds work. How else can I use them? And so it's, I think, everything you would expect in a space like this, a search for more applications of this now well understood evergreen technology.
You said something in there that's so interesting when it comes to where we are in the alternative asset management and traditional asset management world as an industry. There's building going on, there's buying going on, GIP, HPS, Preqin, there's partnering going on. Mm-hmm. In that coterie of decisions that could be made at the strategic level as a firm, I'll start with you, Joe and John. Why partner here? How did you think about the anatomy of a partnership when it comes to something like this?
It was actually a really simple decision. We've known Partners Group for a long, long time, and we respect them so much. They have a great process. They obviously have incredible solutions. They're incredible people. But two things really stood out for us. Culturally, they're very similar to BlackRock, where they are clients first, very client-centric organization like BlackRock. And the other thing that was really important to us is they think about their investments through the lens of whole portfolio. While there's individual sleeves, it's always in the context of whole portfolio, and that's our ethos as well. So when we started to think about who we wanted to partner with, it was actually a very clear decision. And because we've known them for a long time, because we had so many similarities and just an immense amount of respect, it was a pretty easy decision to land on Partners Group for this one.
Something really interesting in there that you said, which is whole portfolio. I think that relates to a lot of the nomenclature that's happening in, I'll call it private markets instead of alternatives. Mm-hmm. So it feels like that private markets, John, I'll ask your perspective on this. There really is no alternative now. You need some, I think you mentioned this earlier, you need some exposure to private markets, right? So how do you think about that concept when it comes to thinking about a partnership? Because it's really, as you've all said, it's about delivering a best-in-class solution.
Absolutely. I think our overall view is the lines are blurring between public and private. And what clients like about public markets a lot of the times is that they're easy to transact in, right? The outcome of public markets is one thing, and then the outcome of private markets is the other thing. And so I think what we've really tried to do with Partners Group, and where we really share two things to kind of dovetail what Joe talked about, which is, one, I think we both have an appetite for innovation. So I think the important thing here was bringing two firms together, because to innovate, you need resources. And so I think us partnering together really was helpful in that. The other one is culture. I can tell you, I talk to Rob almost every day now. We have a great partnership, and we're working really well together. And so I think when you can mobilize like that and really get two firms working together, you can make some really good progress.
And Michael, you used the word alternative. It's interesting because our president, Rob Capito, always talks about making alternatives less alternative. And we think that this construct will do exactly that, where this is all about solving a particular client issue or client challenge or helping a client reach their financial goal. Not being public markets or private markets, but truly a solution that is solving a goal for our client. And I think that's really the beauty of what we're doing.
Rob, I'd love to hear your perspective on that, because you've had to educate the market on private markets for a long time, and not just private markets, but evergreens. How have you thought about the way that you want to build a product like this to educate the market so that they can understand how this fits into a portfolio, how it's not necessarily an alternative, but a core piece of what investors and allocators do?
Well, that's also why this is the right time, because I think some of these very simple data points are now becoming widely understood. 87% of 100 million revenue and above companies are private and not public. So this shift is becoming well understood. It's actually quite easy for the advisor and then the end client to understand that. Many of them work for small businesses, medium-sized businesses, not for public companies. Some of them have traditional defined benefit pension plans. That was the example of my dad, if you recall from our podcast. He was the first investor in our evergreen fund in 2009, July 1st, 2009. He's the pioneer in this industry in some respects. He has a pension. And he said, this is where the action is. 2005, when I joined Partners Group, where can I get this private markets exposure? How can I get it, son? And he understood. So I think it's well understood. Of course, there's education last several years about product structure. And again, that's why the timing is good now, because there's still too much product structural heterogeneity. So this is part of the challenge that this solution solves, right? This is the iPhone, right? This is simple. This is easy. So I think education around the structure will be part of our journey now, but the need is there. It's hand in hand with why we've started this. The clients are asking for it. They're asking for further simplicity. And let me just quickly comment on the partnership. Agreed. I mean, it was an easy decision from the Partners Group side as well in terms of this. And I would say it takes humility. So speaking of culture, it takes humility for two organizations to say, look, we need to work together. And I think we both realized that the ingredients, the capabilities to solve this big, important problem don't reside in one single firm. And in terms of those capabilities, I'll add one other thing, which is experience. It's so important. The other theme of this whole conversation is solving complexity. So the experience that BlackRock has in their business, generally speaking, is incredibly important. The experience they have with model portfolios, incredibly important. The experience we've had managing evergreen funds with private markets, incredibly important. So it's just been an incredible partnership the last almost, I guess, a couple of years that we've been working on this, and we're excited to bring it to market soon.
I think that brings up a really interesting point around the concept of brand and building a brand in private markets for the wealth channel. Educating the wealth channel on private markets is in of itself an endeavor, but then building a brand is so important. How have you, let's start with the BlackRock side of this, as you've thought about this partnership, how have you thought about building that brand and balancing the partnership between two firms to build a brand as a comprehensive solution for the market in this space?
It wasn't priority number one, quite frankly, but we are going to benefit from two wonderful brands in the market. Partners Group has just an outstanding brand across private markets and the wealth space. I think BlackRock is probably a little bit newer from a brand standpoint in the wealth space. We obviously have a brand with our iShares franchise. We have a brand with our SMA franchise. We have a brand with our mutual fund franchise. And we have the beginnings of a big brand with our alternative or private market franchise. But that said, we think that these are two wonderful brands that we're bringing to our clients. And coupled with the solution that we are going to be talking about, we think that, again, it's going to be a big commercial success. But to answer your other part of the question around education, we think that is going to be the cornerstone of how we're going to be talking about this solution. Because while a lot of advisors are still trying to figure out how to add more and more private markets to their portfolio, the solution itself is only part of it. it's also educating them on how to talk about it, how it fits into their broader portfolios for their clients, what the actual outcome will be compared to other parts of their portfolio. So we are going to couple a really wonderful solution with great education for our financial advisors, because we think that is a fundamental building block to building a great franchise, not just for this solution, but for other solutions that will follow.
It's a great point, and I think it relates to the history and legacy of the firm in some senses. iShares is synonymous with ETFs to some extent. What lessons can you take from what you've built on the ETF side, educating the market about ETFs, that you can apply here?
So I think there's a couple of things. I mean, maybe first starting where kind of Joe ended, I think one of the big brands that we want to have is that we can be a holistic provider to our clients. You mentioned iShares. Clients think about us for the liquid market. So as we think about how do you provide that holistic guidance, it's through what we would call asset allocation IP, right? How do you think about the whole portfolio? And through ETFs and mutual funds and SMAs, we have that on the liquid side today through our models business. Our models business is over $150 billion today. So a lot of clients are asking us now, how do you actually incorporate private markets into that? And that's a big reason around GIP and HPS and Preqin, as you had mentioned. As we think about how we built that iShares brand, I think it was really talking about iShares as a technology. It was a way to get access to the equity markets. It was a way to get access to the fixed income markets. If you think about it, the fixed income markets used to be fairly illiquid. We had a lot of clients come to us and say, how can I replicate bonds? And we created iBonds. So all of that is technology. And I think what we're trying to do here with Partners Group is try to make it easier to access the private markets in that regard.
I want to double click on that aspect of things, because I think that the technology innovation that's happening in private markets cannot be decoupled from the distribution revolution that's happening. You mentioned it earlier. You need the technology to be there in order to be able to actually create and distribute this solution. How similar or different do you think those market structure evolutions across equities, fixed income derivatives are going to be to that technology market structure evolution from, I'll use the word trade, it could be investment, but pre to post trade in private markets?
I mean, I think it will all depend. I think we have to see where private markets go. But I think if you think about what's going on with private markets, there are some public markets that don't necessarily settle every day. And I think there is this blurring of the lines. I think what we're trying to do with this solution, though, is going back to Rob's point, is we're trying to take kind of the first step, which is now the industry has created evergreen funds, where you can transact on those evergreen funds typically in a monthly subscription period, and you can have quarterly redemptions. So I think we need to be careful. We're not going to go to I think people sometimes hear this and they hear, oh, is it going to be daily or things going to change? So right now, I think the construct of this solution is we have these evergreen building blocks between BlackRock and Partners Group, and how do we put those together to make it very easy? And so I think we're at step one. To your point, though, if you think about where fixed income markets were 25, 30 years ago, there's an evolution to where they are today. So that's going to evolve, I think, pretty rapidly over time. And I think these curves will go much faster than they did in the future. And I think we see that every day with technology.
Well, that's a great kind of illumination of things, right? The fixed income market electronified. You mentioned the iPhone moment, right? That's to some extent where my mind goes with that is the electronification of private markets in a sense. We're not necessarily at an easy button yet, but we're close. Rob, I want to ask you your perspective on what John was sharing around how those other markets evolved and how you're now seeing investors access private markets, education being so key to that. From the Partners Group perspective, having had to educate the wealth channel and other institutional investors use your funds, both closed and evergreen, but they use evergreens too. So you had to educate the entire market on evergreen structures. What lessons can you take from that you can now apply to the solution that you're building together?
You're right. We've had to cross the proverbial chasms, the entrepreneurial chasms. A lot of that was education. We've done that in the wealth market. For 10 years, we've been in the defined contribution market, similar there. We've had to do quite a bit of education across a number of different segments of that marketplace. What comes to mind when I reflect on this and what's relevant to this solution that we have developed is there's no substitute for excellent execution. Mm-hmm. So importantly, part of this alignment we've had, two organizations in this partnership, is we have to get this done right. And we have to build the right solution, and we have to execute as flawlessly as we can and just prove. And I think that's been the most powerful education that we've done. For example, we used to have to discuss the differences between IRRs and the returns of our funds. So we just had to prove it. Here are the multiple returns from our compounding portfolio, an evergreen portfolio. How does that compare to your commingled fund, your drawdown fund, TVPIs? So you just have to conceptually put out the thought pieces, and then again, there's no substitute for actually proving it. And that's why this has been such a gratifying experience so far, because we are so aligned on making this work out of the gate. Dare I say, we feel some responsibility as innovators in this marketplace to get this done right.
We've been building up to this point of what it actually is and how it's going to work. I think you did a great job of illuminating why the partnership. What's the how? So how does it all fit together, and how have you structured the product to the extent you can share about what it looks like and why you've constructed it the way you've done?
Sure. Why don't I take that one? I think before we go there, maybe we think there's a pretty big client need. We talked a little bit about this whole portfolio concept, and there's been a lot done on the liquid side. But I think what we have a lot of clients and advisors asking us for is how to make it easier on the private market side. And there's a real demand for that. To Rob's point, the markets are changing. There's less public equities and there's more opportunity in private markets. I think we'd all agree the way that the credit markets are structured are changing pretty rapidly, going away from banks into private credit. You have really what we think is a big evolution in infrastructure and certainly in real estate. And so what this will do is kind of take those core building blocks of private equity, private credit, and real assets, use the asset allocation IP from both Partners Group and BlackRock to think about how those asset classes should interact, give custom ability to the client in different flavors. Do you want more income? Do you want more growth? Or are you more of a moderate investor? So we'll have some flavors to these SMA models, and then have the ability to go into our underlying evergreen funds and do some rebalancing and have the ability for clients to get into these with one subdoc and an aggregated 1099. And so that's what we're really trying to do, is provide that asset allocation guidance together, but then make it a very streamlined experience for them through a model's SMA chassis.
What's so interesting about what you just said is that the way you described it, I think, really matters. I think words in this space matter a lot. You say income portfolio, growth portfolio. How much have you all spent thinking about how you actually name these products and these solutions so that the investor can understand, and maybe they take what they've learned from the public markets and think about it in the same way?
Well, I think one of the big differentiators in what we're building versus some of the other products that are possibly coming to market is the ability for the client and the advisor to see all of the line items. So it's not a fund of funds, but it really is a model SMA where they'll actually be able to see the line item for their private equity, the line item for their private credit, the line item for the real assets. And then they can see the actual performance and the performance attribution for each of those. And to John's point, that single ticket, that 1099, really, really easy for the clients to see not only the performance, but ultimately to buy the solution.
How much do you think private markets should not try to become more public versus it should stay like, and even as it relates to product construction, right? We're seeing all sorts of products, some that include liquid and illiquid sleeves, some that are trying to there's closed-end funds on one end, there's all sorts of evergreen structures on the other end. How much do you think that those things should merge together? And I think to some extent inertia will not stop that, but how much should these asset classes stay separate? Because there is illiquidity, and there's illiquidity for good reason in certain cases. So how do you think about that interplay?
I'll take a stab at how I think about that. I think they're coming together. What I think about is how investors need to think a little bit differently about the private side. Instead of thinking of this as the alpha cliche part of the portfolio, this is really that foundational equity part of the portfolio, if I just think about the core private equity of the private markets. And some of the education we've been doing recently is saying, hey, think about what has been successful in your traditional public equity portfolio. Think about time in the market. Think about compounding. Think about rule number one, Mr. Buffett and Mr. Munger. Reading rule number two, don't lose money. Diversification as, the defense that wins championships, right? So it's getting invested, staying invested, compounding in these companies that are foundational to the economy. And so I think there's a bit of education yet to be done there. And I think these solutions, also are really solving the implementation challenge. So I think they should be coming together. I think there's still some work to be done to sort of reorient people to how they think about private versus public, risk, return, market size, those types of things.
But Michael, I actually think there is a definite blurring of the lines between public and private. And I think the technology is definitely catching up where it does enable an advisor to combine the two. And, we've talked a lot about it. The illiquidity of private markets, while it will always be there, you don't need to have an entire portfolio that's liquid every day either. And every client is different. That's ultimately the financial advisor's job and work that they have to do to determine where their client fits on that risk spectrum and how much they need liquid and versus how much they don't need liquid. But with the models that we are building with the technology out there, and the reason we formed a partnership with GeoWealth and some others is to really allow a financial advisor to combine these two solutions together to build a better portfolio to solve a challenge for our client. So I think the blurring of the lines will continue. And again, going back to making alternatives less alternative, but making just better portfolios for the clients.
Maybe to dovetail just real quickly on that, one of the things that we've thought about a little bit as we're constructing products is sort of the access point compared to the outcome point. So the clients want access to private markets. I think the democratization of private markets is a very, very big trend. And so I think everybody in the industry is certainly for that, of getting access in an easy manner to private equity or private credit. I think the interesting part, though, will be the outcome, which is what are some of the things that you like about private markets? One of the things Rob mentioned was risk-adjusted returns. If you have a fund that only prices monthly, the volatility on that fund tends to be lower. When you go into public markets, if you had a daily mark, you're going to naturally have more volatility. I think we've seen this in our ETF business. For example, when we took things that people said you couldn't put into a fixed income ETF, and we put them in there, and then you have the market move. They actually looked at our ETF for price discovery. And so I think you have to think through those types of things as well, which will be interesting.
Brings up another interesting concept too. We've seen it on the public side where there's a question of active versus passive, and investors have to make that decision as to what they want to do passive, what they want to do active. How do you all think that advisors will approach this on the private side, and there's a reason why in kind of the historical sense in private markets, people have mainly outsourced that to a manager who has expertise, and they've been more passive. Maybe they've been active in their allocation decision, but they've been passive once that happened. Once you start to create these structures where there is the ability, and not necessarily in your structure, but just in general with these evergreens or models, you can rebalance and things like that. How do you think about that interplay between active and passive activity from the advisor?
We obviously thought about this a lot back in 2009 when we purchased iShares. So at the time, BlackRock was largely an active manager, and you could have read thousands of headlines that it was impossible to have an active manager have a passive business and for them to coexist. Lo and behold, it worked. And the reason it worked is because advisors really didn't care. What they were trying to do, again, is to solve a particular challenge or to help a client meet a financial goal, irrespective of whether it was passive or active. They were choosing great managers that were achieving certain outcomes to build better portfolios. So we think that that's probably a bit of an analog for private markets and public markets as well. It isn't about whether it's public or private. It is how does it fit into a broader solution to solve a particular client challenge.
You mentioned outcomes. Rob, I'll start with you. What do you think is going to be the biggest challenge in getting the market to adopt something like this?
We believe the market's there. Very simply because the market's asked us to build this. And I think there'll be some challenges to, as we just immediately get to market and some of the education that we've discussed, what is the product? How does it work? But the features that we've developed for the client's needs are needed in the marketplace. So I think we're absolutely addressing a gap that's out there. Some of the challenges that we've thought about in terms of the product design are scalability, right? Diversification, those types of challenges. How can we provide that right balance of the personalization, the flavors, as John mentioned, is really important, and also different from just building a fund of funds type structure, but enabling that advisor to have some value add in terms of how they build portfolios for their clients, have the right portfolio for that particular client. So those are important elements in this design as well.
One thing that's embedded in what you just said is that the managers who are investing in private markets through these structures, they may need to do things differently than a traditional closed-end fund manager, right? Because you may, making this as easy as you're talking about, and I do think this really is differentiated because it's a solution and it may make it easier for people to do this. But then that comes to the question of, okay, well, you raise a bunch of capital, then how do you actually deploy it? And how do you think about that? And it takes, I think evergreens are not so simple in the sense that it requires a different skill set. So I'd love to hear that perspective too, how you've all collectively thought about that, because that is, you may raise a good amount of capital because it's coming from investors who want access to private markets and may not have had it.
Rob, why don't you start? I've introduced you.
I guess that gets back to the experience, and you're absolutely right. I talk about the infinite responsibility we have with an evergreen vehicle. Our clients are signing up for us to invest forever, not a 3 or 4 or 5 year investment period of a drawdown fund. So we have to have those capabilities to build those portfolios, keep those portfolios highly invested, or else we're not compounding, to state the obvious, to have the requisite diversification, that humility that's expressed through portfolio construction we need to have. So that's just the investment engine. That's the investment side of the equation. Then you have to figure out some of the other things we alluded to before, meeting the liquidity desires of those portfolios, addressing valuations, for example, all of those operational considerations. So you're right, Michael, these evergreen funds are not for the faint of heart. They're actually incredibly complex and difficult to deliver the outcome over time through cycles consistently. And again, that's why having the right experience and capabilities that the two firms bring is so important for the solution.
And I think it dovetails to the product. When we looked at this, we thought there were kind of 2 use cases. The first use case, I think, is people think, well, the typical client that can access, if you think about an accredited investor suitability, which was started many, many years ago, there's many investors now that meet that requirement. And one of the great things about the markets being up over the last couple of years is that market's actually grown. And so I think the first use case for this is obviously having more and more people access alternatives. Joe talked about the wealth market being 50 trillion and only about 5% being allocated. That's because a lot of clients aren't allocated to alts. And so that's use case number 1, which is educating them and getting them invested because they haven't maybe known how to do it or had access. I think the second that we've heard from some clients are even advisors that are doing alternatives today, it's hard between drawdown funds and evergreen funds. So we even think that you could use this solution kind of as a base, and then you could put your drawdown funds or your co-investments and other types of things around it in kind of core satellite approach. And so those are kind of the ways that we see clients potentially using these solutions to try to solve that issue, because that's a big industry issue, and that's why we've spent so much time trying to kind of get that right.
Where my mind goes with that, and you've talked about this in different ways today's conversation, but Joe, I'll ask you, like, this feels like a seismic shift in private markets, having the ability to do something like this. Where do things go from here as we think about the next phase of private markets?
We absolutely think this is a seismic shift. I think Rob talked about this being the inflection point. We definitely see the adoption of private markets, the adoption of these types of solutions picking up very, very, very rapidly. We think that it will just spur more innovation. Clients will demand different types of solutions. They will want more flexibility. They will want more convenience. So while the underlying products will continue to innovate, we also think how you access them will continue to innovate, because this is all about making it as convenient for our clients to access a market that otherwise they haven't accessed in the past. We think it will just spur more innovation, both from a product standpoint, an underlying product standpoint, but maybe even more importantly, the technology or the access to add these to your portfolios.
If we were sitting in this room in 2009 and I asked the question, is iShares and our ETFs going to become a big part of people's portfolios? I just wonder if we asked the same, you would have said yes. If we asked that same question today as like, will models be the way that the majority of capital from the wealth channel invests in private markets? Do we think if we come back and do this in 10 or 15 years, will that be what we would say, you think?
We hypothesize that the models business will continue to grow as fast, if not the fastest part of kind of the ecosystem. I mentioned it earlier. We've gone from about $4 or $5 trillion. We think it's going to go to $10 trillion over the next handful of years. We think private markets will be a bigger part of that. But the reason isn't because that we believe it. The reason is because what's happening is financial advisors are finding just incredible scale in their practice by moving away from individual sleeves and building better portfolios through models and SMAs, which allows them to spend more time on things that they really quite enjoy doing and quite are good at. And that is getting more clients, spending time with existing clients and prospects, and growing their business, and leaving the asset management, the investment management to professionals like Partners Group and BlackRock. So to answer your question, Michael, we see this as a huge growth area and probably one of the most interesting areas in our business over the next 5-10 years.
Michael, maybe to also add on, it's always hard to predict what's going to happen 5-10 years in advance, but I think the thing that really has us excited is right now is clients are asking for it. You know, on the public side, coming into 2025, I think the last 12 months where stocks have been down, bonds have also been down as well, right? So just as you think about the need for alternatives in private markets in the portfolio, this is what we're getting asked for. And so I think that if you think public markets are going to continue to be more correlated, we're in more of this kind of world where markets are moving together, getting private markets into the portfolio is really critical as a fiduciary for our clients. And I think that's kind of our guiding light right now, which is the clients are really asking for it.
I think that's a really interesting segue to, you're trying to be a fiduciary for clients. You mentioned, and you mentioned that public markets are becoming more correlated. There's indexation. It's more challenging in some cases for public markets to achieve the returns that investors, you mentioned DC plans, so retirees need. Do you think a product like this really moves the conversation forward about getting private market solutions into retirement plans?
I think it helps. There probably some other things need to happen to continue that to foster that environment for defined contribution to do more in private markets. I think this helps. I think as a potential solution that can be embedded into a professionally managed environment, whether that's a managed account or a target date fund type of environment. So I think it helps. There are probably some other things that need to be done to really get the DC market going. I think really fascinating. I think about ETFs, wonderful, incredible, but people still use mutual funds. There's still important applications of that. I look at my portfolio, I use mutual funds and ETFs and evergreen funds. So I look at the future, and yes, there's a real need for what we're building. There will continue to be widespread use of evergreen funds on an individual basis. There's continuing to be a significant use case for drawdown funds, right? Even though we strongly believe in evergreen funds, there's plenty of strategies that don't fit into an evergreen fund context. So a bit of it is meeting the client where they are, right? In terms of their journey, in terms of their existing portfolio structure, and having this choice. And I think this is another important part of that.
I think Rob's point is really interesting. If you go back 30 years ago, a financial advisor only really had one or two options on how they built portfolios, right? It was mutual funds or individual securities. And then they had ETFs, and then they had SMAs and models. And now they have private markets and active ETFs. And I think it's just a great thing for our industry that there is just better solutions and better building blocks for our clients. So all this innovation, we talk about it sometimes through the lens of the asset manager or the wealth manager. But if you think about it from Rob's dad, they just have so many better solutions and so much more choice on how to build a better portfolio, and at many times at a lower cost. So this has been a huge win for the end client, and that's a good thing.
Actually wanted to go there hearing both of your comments, because I think it's interesting to think about the client today and the client 10, 15 years from now. So we've obviously talked about this in the context of the intermediary, the advisor, and that is critically important in private markets and the distribution of private markets products. But if we think about younger clients, so the millennials, the Gen Zs, they've grown up social media, et cetera. They've grown up investing social on platforms, Twitter, X, et cetera, Reddit, thinking about those. And then they invest through retail brokerage firms. Now, will they continue to do it as they get older is a whole nother question, but I think it brings a really interesting dynamic into this conversation, where I think the first stages of this obviously will all be through intermediaries for the most part, but it should. How much are you all thinking about the client 10 or 15 years from now, whether they'll be the same or different, how they think about investing in private markets? Will they want the more passive experience, click of a button model, or will they want to actually have the ability to pick and choose?
For the end investor, it's interesting. Our experience is that they've been pretty bifurcated, which what we see on the end investor right now is they're very interested in kind of our core building block ETFs that they're using. And then we see them following a lot of meme stocks, to your point. So they sort of have a different type of barbell portfolio at this point. Our view would be eventually, if we can get the education out there, right, to make sure they understand what they're buying, and we can show, to Rob's point, the performance of private markets, I think this is going to be something that's going to be applicable, across the spectrum, whether it's that ultra high net worth investor that's trying to use it as a core, or more just giving access to that end investor. So yeah. I think we're probably not there yet on the end investor, because there's some education that needs to be done, and they seem to be at the extremes right now. But I think they'll move into the middle as time goes on.
Something that I don't think we've talked about is personalization. And to answer your question maybe a little differently, is we think that personalization is going to be increasingly important in building portfolios, especially for that next generation. They've personalized their coffee at Starbucks, they've personalized their shoes with Nike, and they're going to have a higher demand to personalize their portfolio to really reflect their values and other thinking that they may have about what they want in their portfolio. And again, with the technology, and it's one of the reasons we bought Aperio for direct indexing and the ability to really have that personalized portfolio, we think with the additional private markets, it will just be another sliver or another slice they can add to that portfolio to personalize it how they want.
May not be as fun for them, but it's probably better for their financial future investing in private markets like this rather than this barbell of meme stocks. But I think that's one of the reasons, honestly, why private markets is so important in this, is it makes people have patience.
Good point.
Yeah.
I'd love to end by just hearing your thoughts on where you think this is all going. You've all made it very clear to me, even just in this conversation, that this is such a big moment for private markets. I think we can all agree that there's been a lot of innovation to this point, but this is also another step forward. So I would just love to hear from each of you, so you have a chance to share some of those thoughts and everybody can hear where your head is at when it comes to where things are going.
Sure, I can start. I think we've hopefully covered it, and thanks for having us on today. But I think our view is, number one, you need to get the structure right, and really need to make sure we can deliver a product that gives clients exactly what they want, which is really strong performance while managing that risk, while making it hopefully fairly easy, as easy as you can get in private markets. It's, as we said, it's not going to be as easy as liquid markets. I think the really second important thing is, over time, as we talked about, this move to more efficient wrappers are going to evolve. I could say we're very excited to have our friends from GIP join us in infrastructure. If you think about infrastructure, it's been a very long-dated asset class where maybe retail investors haven't done it as much in the past because of the fact that when you went into a drawdown fund, it had longer lockups. But as the industry evolves, putting infrastructure or other assets into there, so I think there's going to be more and more that we can do in these evergreen wrappers. And so the choice is going to expand, and I think that makes the solution even more viable, because trying to make sure we can manage it all for the client, I think will become very, very important.
And those are also ways that investors can get exposure to some of these megatrends too, right? Absolutely. Digitalization, data centers, AI, decarbonization, all of those things were not accessible in a sense, and now they are. Joe?
I'm not sure I can top John's answer, other than we have always used our client as our North Star. And the reason we are here today is because our client has told us that they need this for their clients. And I think that will just continue. Innovation will continue, the markets will continue, and we want to make sure that we are providing great solutions. We don't want to just provide solutions because we can do it. We want to provide solutions that make sense for our clients. We want to make sure that we are providing solutions that are helping them achieve the desired outcomes.
You guys nailed it. I mean, that's it. It's all about the outcome. In our investment committee room at Partners Group, it says we're responsible for dreams, and that's true. That's what drives everyone. It's that investment outcome, and then I think the other dimension here that's so important is time. So with simplicity means time, as Joe said. So that advisor has time to do more value-add activities for that end client. If I'm the end client, I don't have to deal with capital calls or distributions. I can enjoy my life, spend time doing what I want to be doing. Just like 40 years ago, maybe I'd spend time with my stockbroker thinking about which stock I want to buy, AT&T or IBM. Forget it. Now I have iShares. Keep it simple. So those are the underlying themes here, time, outcome, and this is just a great solution, another choice that people have to reach those two objectives.
I think that what all of you said sums it up so clearly. It's you're taking the complex, making it simple, which in this space is not easy to do. You've also done that on today's conversation. You've made something complex very simple for everyone, so I appreciate that, and great to have you on the podcast.
Thanks, Michael.
Yeah. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot, and have a great day.
We're going mainstream.